This week we're starting a mini-series of podcasts based around international tax. And this is an area that, as a firm, we get a huge amount of inquiries. Lots of clients that are paying international tax maybe think they need to, non-residency issues, and it's going to be quite a fertile area for us to talk about over the coming weeks. So I'm delighted to be joined by Sadie Nicholls. Welcome, Sadie.
Thank you for having me.
So you specialise in international tax here at Lovewell Blake, and your typical clients must be, well, quite varied. I don't know if you wanted to just open up by talking a little bit about the day job and the kind of people that you've been helping.
Yeah, of course. So, I'm a tax manager here, specialising in international matters, both advisory and compliance. And I have an array of clients that come in, new inquiries that come through, both individuals, employees, retired individuals, companies, employers, for lots of different reasons. Mm-hmm. And it's my job to navigate them through the UK domestic law, interacting with the double taxation agreement between the UK and the overseas territories.
Perfect, yeah, which we'll come on to shortly. So today we're talking specifically about worldwide income disclosures. So I'll take it back a stage. We'll talk through what that constitutes, who may be impacted and what they need to think about. But initially, let's open up by sort of talking about what constitutes overseas income from the perspective of a UK taxpayer.
Okay, so it can be anything as small as an overseas investment portfolio that receives minimal dividends, interest. It can be rental properties, pension funds, any type of income or gains overseas from assets situated overseas. As a UK resident, needs to be reviewed, because as a UK resident, you're taxable here on your worldwide income and gains.
Right.
And so we must review your overseas assets to ensure we are reporting and taxing them if need be here in the UK.
That feels like an important distinction. If you are UK resident for tax purposes, you pay tax in the UK on your worldwide income and gains.
That's right.
Yeah. Okay.
And that's under the domestic law of this country. We must then further review the double taxation agreement, which does override the domestic law of this country. So they work side by side, but we are guided and governed by the treaty between the two countries initially.
Okay, understood. So if an individual UK taxpayer with overseas income is already suffering tax in that territory, taxes deducted in that country, would they have to pay tax in the UK as well?
Quite possibly, and more often than not, and I refer back to the double taxation agreement. So what we'd need to do is review the source of income with the country's double taxation agreement, and then we can dictate who's got the primary taxing rights, the secondary taxing rights, or indeed the sole taxing rights, which will then dictate the reporting obligations here for the individual taxpayer.
I see, yeah.
And what happens is, if we've got the primary taxing rights, then there is no foreign tax credit relief to be claimed.
Yep.
If we've got the secondary taxing rights, which means that we are taxing the income here, but we're not the first ones to tax it. Mm-hmm. The overseas territory gets to tax it first. The foreign tax paid gets deducted from the UK liability, and it will either reduce it to nil, or there'll be a balance to pay, but it can't create a tax refund here in the UK.
Okay, so what I'm hearing there is, if it is taxed in both territories and this agreement is in place and effective, you would end up, as the taxpayer, paying tax at the higher of the two rates. It may be all in one country and you get full relief in the other, or it may be some tax in the UK, some tax elsewhere. But overall, you'll pay tax at the higher of the two percentages.
That's right, yes. Yeah. And the agreement's in place to ensure that you do not pay tax twice. Mm-hmm. So the treaty relief is there. It's just what the reporting obligations are in each country, as to what needs reporting. But ultimately, you'll pay tax once. It's just how you get to the bottom line figure.
And that double taxation agreement, where I understand that there's a wide range of them, the UK and a number of different countries overseas, that's the starting point. That's the important document that sets out where tax should be paid, either overall or first or second.
That's exactly right. Yeah. It does. And it's on each individual source of income.
Okay.
It needs to be reviewed. And the double taxation agreement covers income tax corporation tax and capital gains tax. So it's
companies
for
as
corporate
well.
entities as well. That's right.
Yeah. You talked about foreign tax credit. How does that work in terms of the tax that's payable and what relief you get for taxes already suffered?
Yes. So if the overseas territory does get to tax the income first or the gain first, when we compute it here under the domestic law of the UK, so just on your self-assessment tax return, we'll have a UK liability. The foreign tax credit then simply gets offset.
I see. Okay. So again, it's part of the work that you do to understand tax paid elsewhere, how much can be deducted and how much is ultimately due in the UK.
That's right. So the initial scope of my work when I get a new client on board is for me to review all of their sources of income and review the DTA, the double taxation agreement, to confirm what their position is here in the UK. And that dictates their reporting obligations and what our next steps are in terms of what needs to go on the UK tax return or the worldwide income disclosure if we've got undisclosed income or gains from earlier years.
Yeah, so we're talking here about where income's already been received in earlier periods and not been declared to HMRC in the UK. So what would be your advice to a taxpayer that finds himself in that situation? They're tuning into our podcast for the first time and thinking, oh my goodness, I've got an overseas pension, overseas property, overseas investments, and I'm resident in the UK. I should be talking to HMRC about this. Is it time to panic or quite often is our work just to sort of settle somebody down and realise that they may have paid the right amount of tax, just need to make a disclosure?
That's right. And more often than not, some of the clients that I do get, it's pension related. And it's usually retired individuals that have simply worked overseas for a number of years, come back to the UK, started drawing on their overseas pension. It's been taxed overseas and they genuinely haven't given it a moment's thought. They've received the net amount and gone on with their day, basically. However, in line with the double taxation agreement, it's likely that the UK are likely to have some form of taxing rights over that income. So the first step for me is to talk to the client and assure them that they're not the first person this has happened to. And I do see it too often, and it's something that I work on regularly and I can assist with and guide them through the process. So once I've established whether it needs to be taxed here, I can then talk them through what the next steps are in getting it all reported to HMRC, which is via this worldwide income disclosure facility, which is a specific mechanism that HMRC have put in place for individuals to capture all of the earlier years without having to fill in individual tax returns. Yeah,
okay, understood. And one of the things you touched on actually when we were talking before the cameras rolled, so to speak, was around the concept of quite a lot of people are very worried that they think they have UK tax to pay. And actually, when they sit down with you and go through their sources of income, the countries involved, quite often there might not be any additional tax to pay and certainly no penalties or interest associated with that.
Yes, and I have seen it quite a lot recently. There's a lot of work that goes into preparing the worldwide income disclosure, reviewing all the sources of income. And if we have the secondary taxing rights, so it still needs to be reported here, but the tax you paid in the other country is relievable here in the UK, we can offset it and the liability ends up being nil for, say, 20 years. So it's an administration exercise for the individual. And at the end of the day, there's no tax due to HMRC, which means there's no penalty or interest charges. So the actual liability may be nil, but it's really important that you get everything submitted to HMRC in order to draw a line under it and start reporting it correctly going forwards.
Because, of course, penalties and interest that HMRC could levy are linked to tax payable. So ultimately you make these disclosures and if there is no UK tax to pay, then the interest and penalties would fall away also.
That's right. And that the interest and penalties, the penalty rate that's applied to the tax, it depends on whether you've been prompted or it's unprompted, which means HMRC may send you a letter because they found out that you've got overseas income and they've prompted you, which will then increase the percentage of penalty that they can apply to the underpaid tax. But if you voluntarily disclose this information to them, so you get ahead of the game, then we can get the penalty rate as low as 0%.
Yeah.
So it's really important that you get ahead and disclose things before they're able to catch up with you, as it were.
Yeah. And one point you just mentioned there, actually, that HMRC quite likely to discover that you do have overseas income. They have sources from abroad. They work with other countries consistently, share information, so that you might think that HMRC may never discover your income, but that is certainly not the advised strategy for any taxpayer that does have overseas assets.
No, that's right. They will ultimately catch up with you.
Yeah.
They do have the exchange of information agreement in place with many other countries, and it's where they're obtaining a lot of their data to send worldwide income disclosure notifications to individuals.
I see.
So that they will eventually,
Yeah.
their systems are getting sophisticated to capture that. So I would just urge you, if you're concerned in any way, just give me a call. We can talk it through. But yeah, get some advice on it for sure.
Yeah, so I guess we're seeing people that have received a letter from HMRC suggesting that they have overseas income sources, in which case certainly get in touch. But even those people that have that income and haven't had a letter from HMRC also need to take action.
That's right.
Yeah.
That's right.
And in terms of our assistance on that, we can, or you can, guide them through every stage, from the initial understanding of what that might mean all the way through to making those disclosures, speaking to HMRC about penalties and arranging payment if there is any tax due. That was kind of a one-stop shop in the most professional sense, that they come to Lovewell Blake and you will guide them through the entire process.
That's right. From the first call, which will be with myself, I will guide you through and tell you exactly what needs to happen, what's going to happen, to preparing. My team will then prepare the paperwork. We'll get it submitted to HMRC.
Yeah.
We'll deal with any inquiries they've got, any additional questions they've got. We'll assist you with the payment reference numbers all the way down to getting the case closed. We can then assist you with completing your self-assessment tax returns going forwards, because the likeliness is that's what's going to be required going forwards.
Yeah, I see. That's fantastic. I really do appreciate that. And I think for me, a real education in terms of overseas income and how taxpayers really do need to be proactive and take good advice in this area. And from your perspective, I think you touched on a couple of other areas, at least certainly around residency, around social security when we caught up before this podcast. But what other areas do you think you'd like to come back and talk to me about?
I'd like to come back and talk about globally mobile employees, because there's so many elements that need to be reviewed. Now that everybody can work from home and remote working is much more common than it was pre-COVID, lots of individuals are taking it upon themselves they're not necessarily being seconded overseas, but rather asking their employer if they can simply go and work in another country, which many roles allow you to do that. And as a result of that, it means that the employer doesn't always take advice on the next steps. For example, social security, that is not covered in the double taxation agreement. There's specific agreements between the UK, the EU and lots of other countries. And it may mean that for the employer, their social security bill doubles overnight by virtue of their employee working in another country. And that's just one element. So the PAYE aspects and the administration around them, there's lots to cover and think about. So I think that'll be a really interesting topic to touch on next time.
Absolutely. Sounds like we really need to get back in soon and talk about that. Well, for now, Sadie, thank you for your time. Have you enjoyed your first appearance on
I have.
on Summing
It's been a
Up?
pleasure.
Yeah.
Thank you very much
Good.
for having me.
So we're looking forward to coming back again and talking further. So thank you. And thanks, everyone, for listening and for watching. Please do join me again next time.